Good morning, everyone. I'm really glad to see that so many of you found your way here this morning. My name is Michael Kunz. I'm a legal partner at MME, and I'm going to be the moderator of this panel today. The topic, as you can see, is emerging global standards for a maturing digital asset ecosystem. Who has the lead? Before we get started, maybe a quick introduction by the panelists, by themselves. Maybe can all of you quickly state your name and tell where you're from and who you're working for? Maybe starting with Alan.
Okay, so I'm Cohn. I think some of you saw me on the first panel. I'm the chair of the Financial Innovation and Regulation practice at Steptoe law firm based in Washington, D.C., and I'm based in Washington, D.C. as well. So.
Good morning, everyone. My name is Verónica Pollak, and I'm Senior Legal Counsel at AMINA Bank.
Good morning, everyone. My name is Andrea Trost. I'm a Senior Associate at MLL, usually based in London. I specialize in Swiss financial services laws, and I have been thinking about how different regulatory frameworks impact crypto assets and crypto services.
Hi everyone, my name is Ballon Ossio. I'm based in London. I'm a partner at Clifford Chance, and I spearhead the global fintech practice at Clifford Chance.
Perfect, thank you guys very much. So let's dive in. If you want to talk about who is in the lead, we have to define what does it mean to be in the lead. And maybe to go a few years back, I think it's fair to say that Switzerland used to be in the lead back in the day, 2017-18. It was pretty much the only jurisdiction when you could get anything done in crypto. And I remember very well that we had clients that came to Switzerland, set up shop there, and we did the regulatory assessment. It was all fine. They launched their product globally, and things used to be very simple. So maybe, Diego, to start with you, how have things changed?
Thank you. Yeah, I think there is a huge paradigm shift in terms of how businesses need to think about their global operations. Because as years have come past, I think there has been there used to be, as you say, Switzerland and other jurisdictions that were sheltered jurisdictions where you could get your license and then effectively operate either on a cross-border basis because you were reverse soliciting or because you were willing to accept a level of legal risk on the basis of uncertainty. There were no rules around crypto. But that has slowly changed with the FATF guidance creating regimes across multiple jurisdictions, particularly in the AML space. And what we've seen is now there are developed frameworks. We just had a panel on MiCA. Obviously, Europe has a regulatory framework. Singapore has one. The Middle East has one. Dubai, Abu Dhabi. And we see other jurisdictions developing their own frameworks. And so what that means, I think, is that we are now coming to a stage where it's no longer a question of where do I set up in order to service my global base, but how do I set up in a more efficient way in order to be able to service a global base, and where do I get many licenses so you no longer have a single license from which you can operate. And I think that's a huge change in the way that projects need to think about licensing, regulation and compliance, because it means that you're going to have to comply with several layers of regulation across multiple jurisdictions.
Okay, thank you. So Veronica, maybe for you, you work at AMINA Bank in Switzerland. So the shift that Diego described, how did this affect you as or your bank?
Yes, we have been seeing an evolution in the crypto regulatory landscape, and we have been adapting to it to properly continuously serve our clients. AMINA Bank was founded in April 2018. We obtained our FINMA banking license in August 2019, and since then we have been expanding globally our operations. We currently have a branch in Abu Dhabi where we hold license for arrangement and dealing. And we obtained that license from the corresponding supervisor in 2022. Afterwards, in 2023, we opened a subsidiary in Hong Kong, and we have presence in Singapore. And we hold license type 1, 4, and 9 in Hong Kong. That allows us to properly serve our clients in securities dealing, offering and asset management. And recently we opened a legal entity in Austria from which we expect to continuously serve our clients adhering to the corresponding EU regulation.
Okay, so I think that's a really good example that also sets the stage for the conversation that we have now. So we understand if you want to be globally active as a crypto company nowadays, you have to be globally compliant. But it doesn't answer yet the question. You still need a home, right? You need to start somewhere. And sometimes people say, okay, I'm going to go to the place with the largest unified market, like the European Union. It may be a hassle, but if I have that license, I can have a very good starting position. But if you don't want to go to the European Union, where do you go? And I would like to talk to you about what are the aspects that are still deciding on whether a jurisdiction is attractive or not. And one of these topics is, in my view, as an advisor, is flexibility when it comes to structure your company. And one of the things I often say to prospects is, if you come to Switzerland, we have a wide variety of company types or entity types that you can choose from, so we can accommodate all types of crypto businesses. And so we all know that one of the key entity types was the foundation. It started in a way with the Ethereum Foundation, then we had Tezos, Cardano, the Web3 Foundation. So many started as foundations and spread from there to Singapore, to Cayman, where I would say the vast majority of crypto project has been set up in the last 2 years. And so the foundation is kind of everywhere. And there was this memorandum issued by A16Z, the crypto arm of Andreessen Horowitz, a VC, that basically pronounced or said the end of the foundation era in crypto, criticizing that foundations are complicated, they're super expensive, they're not decentralized enough, telling people to go for corporate entities instead. And so I want to ask you, Andrea, do you agree with that statement that we do no longer need foundations, that time is over?
Well, I have to admit I didn't read the memo in detail. But look, I think foundations as well as associations are still great choices for legal companies for crypto, and that's for several reasons. I think so these are purpose-driven entities, and they are not for profit. So they are fundamentally different from commercial entities because they don't have shareholders. They're not allowed to do any dividend or other distributions. So with foundations, you can really be sure that all the assets that they have, be it through token sales or assets through donations, grants, etc., they can really only be used for that purpose. And the purpose is usually very difficult to change later. So I think what we have seen with the big layer 1 blockchains like Ethereum and Solana, they have set up their governance entity in Zug in the form of a foundation, and they have made a lot of money through token sales, and they have used these assets then really to foster their respective ecosystems, and as a result of that they have grown quite a lot. And I think another aspect is, because these entities are not for profit, they also benefit from a beneficial tax treatment. So they are taxed, well, at least in Switzerland, on a so-called cost-plus taxation basis, which means basically they are not taxed on the revenues, but they are taxed on their costs. So you add all the costs together, and then there will be a markup of 5%, and then that will be the taxable basis. And then I think another good thing about these entities, especially the associations, is that they have proven to create a great legal wrapper for those.
Yeah, I mean, I would personally agree. Maybe for you, Veronica, your take on this. I mean, AMINA is a bank, and I think a foundation would not be the best model for you guys, but like, what is your take on this memo?
Yeah, it is a very interesting memo. I went through it quite briefly, yeah. And it is interesting to see also from a marketing perspective what might be the intention behind the issuance of this memo, which probably is to bring the crypto business, the crypto industry back to the US, yeah, as it has been the intention from the current administration to foster their industry. Currently, many companies, crypto companies, have been settled around, like in Cayman Islands, as you mentioned, etc. So maybe it is the intention of this existing administration as a strategy to bring this industry back, and with that, to increase their activity in US territory. For us, as a bank, we will continue to serve our clients, whereas their legal structure is as a foundation or as a company. This is an independent decision of our clients.
Okay, perfect. So maybe, Alan, leaving aside whether that was the purpose or not, do you think that, I mean, we've heard that the US is trying to attract businesses. And the memo talked about the corporate model, how corporations are actually better suited for that. Do you think it's likely to happen that a lot of these Cayman entities are going to be dissolved and move to the United States?
Well, look, I think that the most important thing to think about with that piece, and it's not the first time that Miles Jennings from Andreessen Horowitz has kind of has put pieces out about these ideas, but I think looking at it from the US perspective, there was always, particularly when you were establishing a new layer 1 protocol, there was a reflexive copying of the Ethereum Foundation with separating the developer activities from the governance activities and being mindful jurisdictionally of the token issuance issues. And so, especially when Bill Hinman, in his speech in 2018, I believe, kind of tacitly endorsed the Ethereum model, that kind of sent a signal to the industry in the United States that this kind of for-profit developer corporation, nonprofit governance foundation, offshore token issuance was the best model from a US regulatory perspective. I think, you know, in addition to wanting to see companies come on shore in the United States, I think the other way to think about it is that's not optimal from a US perspective. If you're going to operate in the US, that divides up a lot of functions that don't necessarily need to be divided up. And ideally, particularly the new market structure legislation that hopefully will pass this year, really encourages, again, more purpose-driven organizations. And looking at, from a US perspective, we don't, you know, there isn't an easy analog to a Swiss association. And instead looking at the complement of purposes that the entities are supposed to fill, and then using a corporate form that is appropriate, and in fact, trying to innovate, Dunas or Borgs, a corporate form that is either more similar to a Swiss association or more purpose-fitting to be able to take, you know, something like a DAO structure and wrap it with the legal and tax treatment of a corporation.
Okay, thank you. So another point that I see often was often mentioned, that legal certainty is crucial, right? I mean, you want to set up shop somewhere where you have legal certainty, and what we always tell clients or prospects is, at least in our view, one benefit of Switzerland is that you do a regulatory assessment at the beginning, you have clarity on it, and you don't have to look back over your shoulder because you know there's nothing on the horizon that things are going to change. And so maybe a question to you, Andrea. Can you explain to the audience quickly how Switzerland is unique in that context when it comes to regulatory or legal certainty?
Yeah, sure. So, I mean, our regulator, FINMA, issued guidelines on ICOs already in 2018. So already back then, we had legal certainties when it came to token sales. And I think how Switzerland regulates crypto assets and crypto services is quite different as compared to other jurisdictions, especially the EU under MiCA, because we basically don't have one overarching legislation, but we try to integrate the crypto services into the existing legal framework. So we basically look at whether something is related to the financial market laws or not. And only if it is, then we apply the financial services legislation, the AML Act, etc. So this is quite interesting with regards to utility tokens, because they are not regulated, and you can basically offer utility tokens, you can offer services with regards to utility tokens, be it custody services, exchange services, and you don't need to be regulated, and there are basically no requirements around that, which is very different under MiCA, and I think Diego will talk about the UK, where they basically they apply the securities laws on all types of crypto assets and all types of services. So I think in that way, Switzerland is quite unique. And I think we also take a more holistic approach to crypto regulation, as in we also deal with civil law matters. So I'm sure you all know that we have a tokenization framework in place, and there's also rules regarding the segregation of crypto assets in the event of bankruptcy. And so these rules have then led to adequate regulation for also more complex business models like custodial staking as a service.
Okay, perfect. So talk about complex business models. How does AMINA benefit from this legal certainty?
Yeah, legal certainty is the key for the business. This helps us to build trust with our clients. So we provide custody services, staking, deposits. We have a very dedicated investment team solution that receive mandates. We have our trading team, and our clients very much rely on us and on the legal certainty that gives them dealing and entering into transactions with a Swiss licensed bank.
Perfect. I'm going to skip the US for this question because we all know it's a little bit of a mess at this stage. We hope it's going to get better. But maybe about you, Diego, for the United Kingdom, do you think that, would you be comfortable saying that there's a legal certainty clarity regarding crypto in the UK?
Yeah, so I think you need to sort of distinguish when we're talking about legal certainty is what we're talking about, right? So when we think about legal certainty in respect of treatment of crypto assets as property and the ability to transact in crypto assets, ability to put them in a trust and segregate, all of those things, I think there is quite a lot of certainty, and there's been cases being ruled at the High Court around Bitcoin and generally crypto assets, and there's been a jurisdiction which has been quite flexible and has enabled those judgments. So there is legal certainty on the civil or commercial treatment of property. I think where the legal certainty has been lacking, or not lacking, but there was no framework, which meant that it was up to now sort of pretty easy to operate, is the position around the regulatory treatment for providers and how they should be licensed. But that is rapidly changing. So there are two consultation papers out at the moment by the FCA and PRA. There is also a draft statutory instrument amending the financial services law that we've got, which will create a framework which will fold in the crypto asset definition into the wider financial services framework as a separate activity, if you like, but is sort of within the broader perimeter, which means that firms that operate within that perimeter will have to seek a license with the FCA and will have to comply with the normal requirements. Now, those requirements are based off essentially MiFID and securities rules and some of the custody concepts that we've got in the UK. So that's going to be a very similar concept and outcome to MiCA, but it's not a self-standing framework.
Okay, thank you. And another thing that I see is really, Switzerland did well in that sense, is that you have an easy way to access bank accounts. So when we have crypto companies set up shop here, the question is always, can I get a bank account? And I would say the answer now is a resounding yes, you can. We wish there were more regional banks that would be able and willing to open, operating accounts for companies. But that's not like that in every jurisdiction, obviously. And one thing I would like to ask you, Alan, what I've read a lot about is this Operation Choke Point 2.0. I'm not sure, that's probably an unofficial term. But can you tell us what that was and what the outlook on that is?
Yeah, so Operation Choke Point was an effort by U.S. federal financial regulators to clamp down on illegal money laundering and other activities by a range of different entities, and that was more of an official type of activity. Operation Choke Point 2.0 generally refers to the effort by the same federal financial regulators to squeeze financial institutions and pressure financial institutions into not banking entities that handled cryptocurrency in the United States. And that was a real effort, and that made it very difficult for cryptocurrency companies, particularly those that didn't organize under a form of a limited purpose trust or other types of defined but very difficult to get and obtain in the United States kind of structures to be able to bank. And I think as people probably saw, there was an effort to use the Freedom of Information Act to get information about how the financial regulators were communicating with banks about this. More is likely to come out about that. But ultimately, I think we're likely to see both a relaxing of that approach, but also, I think, paired with the market structure legislation as a digital asset or cryptocurrency companies kind of come into the licensure framework and the registration framework and become one of these recognized types of entities, you'll see the bank, you will likely see the ability to bank in the US become more open and more banks looking to bank in the space.
Yeah, when we talk about banking and custody specifically, I think another asset of Switzerland is what you've mentioned before about these benefits for custodial service provider when it comes to the security of assets. This is more important for users, but it's nevertheless important because it's one of the things you want to offer to your clients, the safety, security, that sense that their assets are actually being safe. So maybe Veronica, can you explain how the security of assets is guaranteed in Switzerland?
Yes, sure. We have mainly two important pillars. First, the deposit insurance scheme, which is by SE Swiss, and secured assets up to a maximum of 100,000 Swiss francs. So this is for individual clients as well as for corporate clients. If a client has various accounts, those accounts will be put together, and still the maximum of this deposit insurance scheme will be 100,000 Swiss francs. But in addition to this, we have the segregation. And the asset segregation is a very important tool that we have here in Switzerland. This means that as well for individual clients, for corporate clients, in the event of insolvency, the assets of our clients will be put separately, will be segregated, and will be taken back to the corresponding client. And this is established in the Swiss law, Article 16, 1 bis, 37 of the Swiss Banking Act, and there are other associated relevant provisions. So this is also linked to the legal certainty. Yeah. So it is important for us that our clients understand your wallet, your assets.
I think that's really crucial, and I mean we see differences there from jurisdiction to jurisdiction, and what brings me to the last segment of our talk today is we want to talk about global standards. So basically, more broadly, how can we reduce friction for cross-border services? And obviously global standards would be fantastic. So there's going to be a standard that everybody follows. But I think there's not a lot of things we can point to when you talk about that. What comes to mind to me is the Financial Action Task Force, who has issued recommendations. And so FATF, as it's called, was founded in 1989 to combat money laundering at the initiative of the G7. But the problem is a bit, is this democratically legitimated? Like how do these entities or organizations function? Maybe Alan, I want to ask you, like, what's your view on that? Do you think FATF is neutral?
I mean, look, I think that FATF is as good a forum as any for countries regulators to get together and to try to come to consensus around a discrete set of rules, in this case, anti-money laundering rules. Is it the case that countries that have more well-developed systems are going to be able to influence the debate more by bringing those structures and systems to the table to propose them for implementation? Yes. And is it also the case that, particularly in the crypto industry, I mean, in the United States, our Financial Intelligence Unit, our RFIU, FinCEN, was the first federal financial regulator to stake out a regulatory position on crypto that enabled companies to comply as opposed to this kind of, it's all illegal. And so I think that definitely led to, as that structure developed, to the US being able to push rules through or guidelines through in the 2017 timeframe when the US kind of chaired FATF. But even with that, and perhaps accepting some outsized US role in that, I do think it's a good forum to be able to bring relevant countries together and to debate, how do we harmonize approaches in this particular area of regulation.
Thank you. So then I would say, like in the absence of such initiatives, as we haven't really seen many, the second best thing to having a global standards would be harmonization, right? And harmonization, how does it happen? Usually you have one jurisdiction taking a leap, coming up with a solution, and other jurisdictions following along. And so is this likely to happen? What do you think, Andrea?
I don't think it's going to happen that different jurisdictions are going to have the same rules. I mean, it's not happening now. There is a lot of fragmentation out there. I think what harmonization should look like, let's look at stablecoins, for example, is that one country recognizes that another country has rules in place for stablecoins and that there is a regime in place that adequately protects for the underlying reserve assets. And so that first country would then allow the stablecoin to be used as a means of payment in its own jurisdiction. And I think this is very similar to the concept of regulatory difference that we know between Switzerland and the UK, and that's now integrated in the Financial Services Agreement.
Okay, so let's say we don't have a lot of global standards, there's not going to be a lot of harmonization, so what's left? And I would say probably the status quo is going to be prevailing. We're going to have competition between different jurisdictions, so the question is going to remain relevant, where do you want to start? And when you talk about competition, there's various ways how you can compete with others, and two of those obviously are innovation. You want to be innovative, you want to be better than others. The other point is you want to be more protectionistic. And so I wanted to talk about that quickly. Maybe Diego, the UK has issued like this digital security sandbox, DSS, a while ago. And from what I've understood is that it's different than the EU sandbox. And it sounded to me like that's kind of an innovation example. Can you talk a bit more about that?
Look, I think the EU's EU DLT pilot regulation has had a difficult start. I mean, we only have seen one official project so far. It's been live. It's about to run off, and we only seen one project actually get on it. There are 2 or 3 in the pipelines and some publication of rules. So it's a handful of projects where the initial intention was for it to be very, very robust and all-encompassing. I think what the UK has done in that context, and it's notable here that we're not talking crypto, we're talking traditional securities in a tokenized or digital form, is that it has looked at the EU's regulation and tweaked it and sort of tried to improve on some of the flaws that it had. The jury is still out whether that's going to be successful or not. At least the UK has a few applicants. I think we've got about 10 or 12 applicants at the moment on the list, and fundamentally there's going to be a change. I mean, it is an example of innovation. One thing I would say is when you're looking at global competition between jurisdictions, one of the things that is really important to take into consideration as a company is what's the carrot and what's the stick. So if the carrot is a huge market of 300 billion people, you're probably more willing to go through a really rigorous regulatory process, right? If the carrot is only, 2 billion people, then it may not be worth it. So I think that's what jurisdictions need to realize, and I'm being a bit flippant here, but I think that's something that some policymakers don't necessarily recognize. They think about their framework as something to solve and something to protect, but then they don't see the commercials around this. So to be competitive, I think that's the key, to recognize what is this market bringing to the companies, and how do we position ourselves so that people want to set up here? What's the carrot?
I think that's a good segue to the other way how you can be competitive, which is being more protective of your own markets. And I think a very attractive, if not the most attractive market globally is the United States. We've seen a lot of, the tariffs is a good example currently put in place by the Trump administration. But I mean, in general, when you look at the regulatory landscape, would you say, Alan, that the United States is protecting its own markets?
You know, it's interesting. I'll channel our current president, but this has carried through for a long time, many administrations in the United States, is that the United States just looks at the United States first. And the United States has a long history of simply saying, we're going to look at our own markets, our own regulatory structure, which is different and potentially more dysfunctional, and the way that we want to structure things. And if that harmonizes with other parts of the world, that's great. Typically, though, that comes afterwards in long processes through the OECD or other things like that. But I think the United States takes the position of, yes, we have a market that everybody wants to access, number one. Number two, we are here, kind of insulated in our own world to a certain degree. And third, we're going to do what we want. And as a result, I think, as we were talking about before with anti-money laundering at FATF, we innovated, and we brought that to the rest of the world through whether it's the AML directives in the EU, picking up different pieces, or in FATF adopting, or we have never recognized the concept of a utility token. We are going to be potentially imposing the concept of a digital commodity, and people can adopt that or not. And so I think that's always been the US's regulatory perspective is we're going to do what we think is right for the US market, and if you want access to it, this is kind of just the way that it works.
Okay, perfect for that. Thank you for that. We're out of time. I want to thank you all for your participation and all of the others for listening.
Thank you.